Did you know that 80% of the stock market is owned by only 10% of the population? Sounds shocking, doesn't it? It's a common belief that the stock market is a playground exclusively for the wealthy, the high rollers, the Wall Street wizards. But here's the truth. This is a myth, a misconception we're here to shatter. The stock market is not some elite club with a velvet rope, barring the everyday individual from entry. In fact, it's a vast, dynamic marketplace that's open to everyone, regardless of their financial standing. It's a place where businesses raise capital, and investors, both big and small, can stake their claim in these businesses, hoping for a return. The key to unlocking this marketplace isn't a hefty bank account, but knowledge. Understanding how the market works, the forces that drive it, and the strategies for navigating it, can turn this seemingly intimidating world into a powerful tool for building wealth, and that's precisely what we're here for. Today, we're going to embark on a journey to debunk myths and uncover truths about the stock market. We'll explore what stocks are, how to choose where to invest, and how to make your first investment. We'll take you through the basics, all the way to making your first purchase of shares. By the end of this journey, we hope to equip you with the knowledge you need to start your own adventure in the world of investing. Remember, the stock market isn't a casino where fortunes are made or lost on a roll of a dice. It's a platform for long-term wealth creation, where informed decisions and strategic planning can pave the way for financial growth. So let's break down the barriers and demystify the stock market. Let's dispel the notion that it's an inaccessible world reserved for the affluent. Because the truth is, the stock market is accessible to everyone. And today, you'll learn how to get started. Before jumping into the stock market, you need to be prepared. Let's break down what that preparation looks like. Firstly, set specific financial goals. Are you investing for retirement, a down payment on a house, your child's education, or perhaps a dream vacation? Identifying your goals will guide your investment strategy. Remember, investing isn't a get-rich-quick scheme, it's a long-term commitment. Secondly, establish an emergency fund. This is a safety net, typically 3 to 6 months worth of living expenses. It's your buffer against the unexpected, like a job loss or medical emergency. Having this fund means you won't need to dip into your investments when life throws a curveball. Now, let's talk about risk tolerance. Everyone's approach to risk differs. Some of us are daredevils, willing to take on high-risk investments for potentially higher returns. Others prefer the slow and steady route, opting for low-risk investments. Understanding your risk tolerance will help you choose the right investments. Remember, it's not about being fearless, it's about knowing your fears and managing them. The stock market isn't a guessing game, it's a field of study. This means you need to commit to continuous learning. Keep abreast of market trends and economic indicators, read financial news and analysis, educate yourself on different investment strategies and philosophies. Knowledge is your best defense against investment pitfalls. Finally, remember that investing is a journey. There will be ups, downs, and detours. There might be times when you feel like throwing in the towel, but stay the course. Keep your eyes on your financial goals. Adjust your strategies when necessary, but never lose sight of why you started investing in the first place. With your financial ducks in a row, you're ready to take the plunge into the stock market. Remember, the journey of 1,000 miles begins with a single step. So take that step, start investing, and watch your wealth grow over time. Scene script. Stocks represent ownership in a company, but what does that mean for you as an investor? Well, when you purchase a stock, you're essentially buying a small piece of a company. You become a shareholder, holding a claim on part of the company's assets and earnings. Now, there are two main types of stock: common and preferred. Common stock usually entitles the owner to vote at shareholders' meetings and to receive dividends. Preferred stockholders, on the other hand, generally don't have voting rights, but they have a higher claim on assets and earnings. So how can stocks be profitable? There are two main ways. First, through capital gains. If the value of a company grows over time, so does the value of your stock. You can sell your shares for a profit, which is known as a capital gain. Second, through dividends. Some companies distribute a portion of their earnings back to shareholders as dividends. Now let's talk about diversification. This is an investment strategy that aims to reduce risk by spreading investments across a variety of financial instruments, industries, and other categories. It can protect you from significant financial losses if one of your investments performs poorly. In the context of stocks, this could mean investing in a mix of different industries or regions. But, just as with any investment, stocks come with risks. The value of a stock can rise and fall, sometimes dramatically, due to factors like the company's performance, economic conditions, and market sentiment. If a company goes bankrupt, its stock can become worthless. So while stocks can offer high potential returns, they also carry a level of risk. And that's okay. Investing isn't about avoiding risk. It's about understanding it and managing it effectively. Always remember, the key to successful investing is balance. It's about finding the right mix of different investments to meet your financial goals and risk tolerance. Stocks can be a profitable investment, but they aren't without risks. So before you dive in, do your homework. Understand what you're investing in, and make sure it aligns with your financial goals. And remember, you're not alone in this journey. There are plenty of resources out there to help you make informed decisions. There are thousands of stocks out there. How do you choose which ones to invest in? You may find yourself asking this question as you embark on your investing journey. Don't worry, it's a common question. And the answer isn't as complicated as you might think. Let's start by talking about different strategies for choosing stocks. One popular approach is value investing. This strategy involves seeking out stocks that appear to be undervalued by the market. These are companies whose stock prices are low compared to their intrinsic value. Value investors believe that the market overreacts to good and bad news, resulting in stock price movements that do not correspond with the company's long-term fundamentals. The trick is to identify these opportunities before the market corrects itself. On the other hand, we have growth investing. Unlike value investing, growth investors are less concerned with the current price of stocks and more interested in the company's future potential. They are willing to pay a high price for stocks if they believe that the company has significant growth potential in the future. This strategy can be risky, but it can also lead to high returns. Now you might be thinking, that sounds like a lot of work. Is there a simpler way? Well, yes, there is. Let me introduce you to the concept of index funds. An index fund is a type of mutual fund or exchange-traded fund with a portfolio constructed to match or track the components of a financial market index, such as the Standard & Poor's 500 Index, S&P 500. This is a way to diversify your investment and reduce the risk associated with investing in individual stocks. Choosing where to invest requires careful consideration and research. It's about finding a balance between risk and reward that fits your investment goals and risk tolerance. Remember, investing is not about getting rich quick. It's about building wealth over time. So take your time, do your research, and make informed decisions. And remember, it's never too early or too late to start investing. Choosing where to invest requires careful consideration and research. You're ready to make your first investment, but how do you actually buy stocks? Well, you've done your homework, you've chosen your stocks, now it's time to take the plunge. But where do you start? The answer is a brokerage account. This is an account you open with a stock brokerage firm which allows you to buy and sell stocks. It's like your gateway to the stock market. Once you've set up your brokerage account, you're ready to start investing. You'll need to decide how many shares you want to buy and at what price. Remember, it's not about how many shares you have, but their value. Now let's talk about dollar cost averaging. This is a strategy where you invest a fixed amount of money at regular intervals, regardless of the stock price. This way, you buy more shares when prices are low and fewer when prices are high. It's a long-term strategy that can help smooth out the highs and lows of the market. Once you're set, you place your order. The brokerage firm takes care of the rest. They'll buy the shares for you and put them in your account. And just like that, you've made your first investment. You're officially a part of the stock market. You're not just observing from the sidelines anymore, you're in the game. Congratulations, you're now a stock market investor. Investing in the stock market is a journey, not a destination. As we've explored, it's essential to understand stocks, identify where to invest, and make informed decisions. But remember, knowledge is power. Continue to learn, adapt, and evolve your investment strategies. Be aware of the risks, and never invest more than you're willing to lose. Remember, the key to successful investing is patience and persistence. Subscribe to our channel for more videos on building wealth.